In this video, we are going to talk about another way that you can obtain financing for a home purchase without using the traditional loans that are available in real estate, like an FHA or conventional loans, which are the two most common ones that lenders give to home buyers. There are also some other great loan programs, like you have the VA loan for veterans and the USDA loan for home buyers that choose to live in rural areas. But there is one other great way you can get a loan without even going through a bank or lender. And I know some of you are thinking, well, how can this be? This sounds too good to be true. But you guys, in this case, it is true. So if you can't qualify for one of the traditional loans because of bad credit or other obstacles in your way, you can get a loan by another way, and it's called seller financing, which is so amazing if you can do it. With seller financing, this is when the home seller of the home you want to buy finances the home for you. So the homeowner essentially becomes the bank, and you make your monthly mortgage payments to the seller. And then you eventually will take title and ownership of the home once you pay off the price. So you may be wondering why a home seller would want to do a seller financing deal with you. And how do you find out if a seller is willing to do a seller financing deal? And I'm going to break it all down to you in today's video, and I will give you all the ins and outs of seller financing, and you will be amazed and surprised, and you'll want to do it right away. My name is Cherilyn Williams. I'm a local Chicagoland realtor, and I provide real estate education to home buyers that have questions or need better understanding on all things pertaining to the process of buying a home. Also, if you like this video, please press the like button, comment, share, and subscribe to my channel for weekly real estate content made just for you. So as I mentioned, seller financing is when the owner of a home acts as the mortgage lender when selling a property to a buyer. With seller financing, a buyer makes monthly payments to a seller of a home instead of using a traditional mortgage. Now, the seller of the home decides what the terms of the buyer's payments will be, including how often the buyer will make payments, what the payments will be, and also the interest rate. Once both the seller and buyer come to an agreement with the terms, they write up a contract with an attorney. Then, over time, once the buyer has paid the seller the full purchase price amount plus the interest, the seller will transfer full ownership to the buyer. So as you can see, it's pretty much the same process as if a buyer was using a traditional bank or mortgage company. So why would you, as a home buyer, want to do a seller financing deal with a home seller? The main reason why seller financing is great for a home buyer is when a home buyer can't get qualified with a traditional loan. If you don't meet the credit score requirements or you have a low income to get qualified with a traditional loan, seller financing could be a great way for you to become a new homeowner. Now, let's explore the advantages to a buyer in doing a seller financing deal. What's cool about seller financing is that you and the seller can come up with your own terms that you all can agree upon. So essentially, it allows you the freedom to make a deal happen the way that you want and not the stringent rules that a bank or lender would want you to have. This type of agreement is so awesome because it can allow you as a buyer to put down a lower down payment than what you would have to do with a more traditional loan. Also, if you don't have the best credit score, seller financing won't necessarily disqualify you from buying a home like a traditional loan would. And as long as the seller agrees and you agree upon the terms, you are all good. So the flexibility of seller financing, where you can make decisions on how you want things to be structured, is both appealing to both a seller and a home buyer. Now, let's talk about the advantages to a seller. All right, now one advantage to a home seller is that it can allow them to have a quicker sale and an easier transaction without a mortgage lender to deal with. Because many times with a traditional mortgage, the home seller is at the mercy of the buyer's bank or lender to approve the buyer's loan. And the whole time the buyer is in the underwriting process, every seller, whether they want to admit it or not, is always thinking in the back of their mind, what if the buyer doesn't get approved and the deal falls apart? Because this does happen. And this can cause a lot of stress to a home seller as well as a buyer too. Another positive thing with seller financing is that it increases the interest and pool of buyers a seller may get on their home, because it will bring in the home buyers that are struggling to get qualified for a loan the traditional way to the seller's home, bringing in tons and tons of interest. And of course, a seller wants as many interested buyers as they can get. Now that we got the advantages and disadvantages out of the way, let's talk about the 5 types of seller financing that are available to you. You can obtain seller financing through a land contract, an assumable mortgage, a lease purchase, a land loan, and a wraparound mortgage. So let's first start off talking about a land contract. And I know this name sounds like it's really something major, but basically, you guys, it's the same as a rent-to-own home. In a land contract, you, the buyer, will make monthly payments directly to the owner of the home for sale until you pay the final purchase price of the home. While you are making the payments, the seller will keep the title of the home in their name until you finish making all the payments. So basically, you are renting the property until you pay for the home. Oftentimes, a land contract includes a balloon payment at the end of the repayment period. And if you don't know what a balloon payment is, it's just a one-time large payment will be made at the end of the loan term. Now, this large payment is much more than your regular monthly payments that you have been making throughout the loan term. And both you and the seller can negotiate or decide in the beginning on what you want that large final payment to be. But I do want to warn you, if you decide to do a land contract with a balloon payment at the end, make sure you agree with the seller what that large payment will be before you sign any contract, because the worst thing you can do is not be prepared or can't afford that large lump sum payment at the end, and you'll be looking weird. Okay, now moving on to the next type of seller financing, and that is out there, and that is the assumable mortgage. With the assumable mortgage, you, the home buyer, will take over the existing mortgage of a home seller. And one of the main reasons why you would do this is if the seller has a very nice or low interest rate that are below current market interest rates. So if a seller has an interest rate of, let's say, 3% and the market rates are like they are today at 6.5%, this could be a great way for you to get into a home with a lower interest rate and lower monthly payments. Now, the only way that you can assume a seller's mortgage is if they have a government insured loan like a FHA, VA, or a USDA loan. Conventional loans cannot be assumed because it's not part of a governmental agency. So keep that in mind if you are searching for a seller's mortgage to assume. So remember, a seller cannot have a conventional mortgage, okay? Now, another thing with an assumable mortgage is that you, the buyer, would have to pay the difference of the purchase price and the remaining balance in the seller's mortgage in order to get the home. So that would be your down payment, and that could possibly be a lot of money, unfortunately. For instance, if a home seller still has a remaining loan balance of, let's say, $100,000 on their home, and you buy the home for a purchase price of $200,000, you would need to pay out of your own pocket the difference, which in this case would be $100,000 cash that would act as your down payment. And you know, this could really pose a challenge if you don't have that large sum of money available like this for the difference. But if you do, assuming a home mortgage from a seller could be a great way to buy a home below current market interest rates, as long as the seller already has an existing low interest rate. Now, the next type of seller financing you can use is a lease purchase. And this is very similar to the land contract that I mentioned earlier, and probably one you're most familiar with. With a lease purchase agreement, or also known as a rent to own, you, the buyer, would pay rent to the owner of the home, and you would also have to pay pay an option fee that gives you the right to buy the home at the agreed upon fee after a certain number of rental payments. Now, this option fee is an upfront, non-refundable fee. So if you decide not to buy the home, you could lose your option fee and any additional money you paid to cover the down payment. With the lease purchase, a portion of your monthly rental payments may go towards the down payment for the home if you decide to exercise your lease option to buy the home. Sometimes with a lease purchase, it can be risky because you could lose the option fee. And sometimes the rent payments that you make will be higher than market rent prices. But if done correctly, a lease purchase can be a great way to buy a home. Now, you can also get what they call a land loan. And if you are a buyer that wants to buy land, this could be a great option for you. Now, basically with a land loan, you will be paying the owner of the land and you won't be using a bank or lender. And this is pretty simple and self-explanatory. Now, the last type of seller financing is the wraparound mortgage. Usually with the different kinds of seller financing I have mentioned, the seller's home doesn't have a mortgage on it at all, and the seller owns their home outright. But with a wraparound mortgage, a seller may still have a loan on their home, but they are still willing to do a seller financing deal with a buyer. In this arrangement, you, the buyer, would make your monthly payment to the owner, but for an amount higher than the seller's monthly mortgage payment. And then the seller collects the payment every month and then pays their own mortgage lender. Then the seller can then keep the leftover money that you paid as their profit. So if the seller's monthly mortgage payment is $1,500 and they charge you $1,700 rent, the seller can keep your $200 that is left over in their pocket as profit. Now, with a wraparound mortgage, you have to be very careful though, because sometimes they come with higher interest rates. And if the seller so happens to default on their mortgage, you, the buyer, could lose the property even if you've been making the payments regularly and on time. And one last thing you should know is that the lender working with the seller may not like or accept this kind of deal at all. So the seller needs to check with their lender first to see if this is okay for them to do this. And many mortgages have a due on sale clause, which means the lender may demand that the seller make a full repayment upon the sale of their home or when the property ownership has been transferred. So it's quite possible a lender could demand that a seller pay in full and not do a wraparound mortgage at all. So this is something that definitely needs to be checked out beforehand. Now, there are some more advantages and disadvantages of seller financing for both sellers and buyers that I want to talk about. But first, let's talk about why a home seller might want to do a seller financing deal with a buyer. Now, one reason is that with seller financing, a home seller can close quickly because the home buyer is not going through the long and sometimes arduous process of underwriting with a loan or with a bank or lender, which typically takes between 30 to 45 days from beginning to end. With seller financing, a home seller and buyer can close on the home on an agreed upon date or time. It could be a couple of weeks, it could be a month, or whenever they both choose. Also, with seller financing, a seller can also save on their closing costs. The seller doesn't have to worry about all the document preparation fees from a title company and all the other closing cost fees that come with selling a home. A seller can just hire an attorney to represent them and only have to pay an attorney fee along with other minimal fees. So it can be a very easy process, which is very attractive. Seller financing can also be great for a home buyer because, like I already mentioned, if you have issues qualifying for a traditional loan, or if you are a low income buyer or don't have a fairly decent credit score, having the seller act as your bank can be a great way for you to buy a home. This can also help you save on your closing costs just like it would for a seller. And if you can work out a deal with a seller, you won't have to pay private mortgage insurance if you're putting less than 20% down like you would with a traditional loan. And so these are some very clear advantages for both sellers and home buyers. Okay, now let's touch on some disadvantages of seller financing for buyers, because buyers may be looking for seller financing. A lot of times, like I said, they have lower incomes and credit scores, and some sellers may want to charge a higher interest rate and they may want you to put more money down for a down payment because of this. So this can be a clear disadvantage to a home buyer. However, if you have a decent income and your credit score isn't too bad, a seller may be able to give you a lower interest rate than what is out there in the current market interest rates. Seller financing has also fewer protections for buyers as well, because a bank or lender is not doing the loan. There will be more flexibility in terms, but not as many protections. So it can kind of be good, but it can also be kind of bad. That is why you want to get a great attorney to put together an ironclad contract to protect your interests. And another thing you have to think about is that your monthly payment to a seller will be a private payment. So this means your on-time payments that you make every month won't be reported to the credit bureaus, which means you won't see any increase in your credit scores when you make your on-time payments. Because when you make on-time payments to a mortgage lender, this is always reported to the credit bureaus, which helps your credit score increase. And one last negative thing with seller financing, if, God forbid, if the home seller collects payments from you, but they don't make their monthly payments to their lender for whatever reason, and hopefully it's not because they're not, spending your money lavishly, like in the case of a wraparound mortgage, and let's say the home goes into foreclosure, all the money that you paid to the seller over time could go down the drain and you lost all of it. And that would really tick you off, and that is just an understatement. So the next question is, how do you find a home seller that would want to do a financing deal with you? One thing you're going to have to do is be proactive, because these deals are sometimes very, very hard to find. These deals are often not advertised, and not every home seller wants to do a seller financing deal. Now, your first step to find a seller financing deal would be to talk to different real estate agents and build relationships with them. Realtors have so much access, and we know many people just because that's our job, and we may know sellers that want to do a deal through our MLS or off-market sellers. So start with talking to some realtors in your area, because often we have many connections with a variety of people. Another great way is by targeting for sale by owner listings, because these sellers have more flexibility and may be open to seller financing. And one other very non-conventional way to find a seller financing deal is to drive around neighborhoods like wholesalers do. And that's what they call driving for dollars. If you see any distressed properties that have unkept yards, or a home appears to be vacant, you can get the property owner's contact information from the local county tax assessor's office and contact the owner directly to see if they are interested in selling their home to you, and if they would consider doing a financing deal with you. Also search on properties that are in the pre-foreclosure process. Sometimes these sellers are highly motivated to sell quickly and may be open to seller financing. You can also join real estate network groups in your area or on online message boards, where you can meet and talk to all kinds of people and investors that may be interested in connecting with you. Just know that not all home sellers know about this type of deal, or may not want to do a seller financing deal at all. So you may face some rejections, but with consistency and being persistent, you may come across a deal that can happen for you. So seller financing has some clear advantages if you are wanting to buy a home and may not meet the traditional standards of a home approval with a bank or lender. But with anything, potential risks are involved. So it will be essential that you consult with an attorney and a financial advisor before entering into any seller financing agreement. An attorney can help you understand the legal implications and draft any documents that may be needed. And as always, have a good realtor on your side as well. Until next time, thank you for watching.